Robschild, not investment advice. Welcome to the show where we view financial markets through crystal ball gazing. I had mentioned yesterday how I was very confused at what was going on in markets. We saw a little bit of follow through. I think I want to see what happens Monday, Tuesday to really see what is really going on here, if the markets that look like they're getting legs actually have legs or not. But even if they do have legs, it's hard for me to believe that they will hold very long. This is, overall I'm seeing markets as sort of a Jenga tower. Sometimes markets are like a gold brick on the ground and you'd be stupid to not pick it up. And sometimes markets are like a Jenga tower made of crystal blocks and you'd be stupid to try to touch it. And I think we're closer to the Jenga mode right now, but that's just me and my crystal ball. Today is Friday, July 12th, 2024. Today's episode will start with a PPI that came out. Basically, it's not as important as the PCM or the CPI data, but, the regular PPI came out a little bit higher than expected. Last zero, expected 0.1, actual 0.2. Core, last 0.2, expected 0.2, and the actual was actually cooler at 0. I don't think any of these numbers had much of an effect on anything. The first thing I want to bring up is the VIX, and I'm going to say the longer the VIX stays low, the worrieder I get. As you can see in this chart of the VIX right here, we had been previously having spike after spike. We've been coiling up, getting tighter and tighter at a relatively very low range on the VIX. The longer this goes, the higher there is a chance for this to explode higher to the upside, in my opinion. Starting with SPX, the SPY, this is certainly not nearly as bullish as looking as it had been before. Yesterday we had a pretty good engulfing red candle of the previous day, and today, with a solid candle, looks like we might be developing some kind of flag pattern. This is definitely not very bullish looking. And then similarly in the Qs, the NASDAQ, this is even more clear of your typical bear flag. So you have your big red candle engulfing all 4 of these previous days, followed by a candle in the lower part of the candle, and this is actually bearish here, which means it could be going down. But the really wild thing going on here is, as I mentioned in the beginning of the show, you have IWM, the Russell 2000, just gapping up here. We went up yesterday, it had gone up 3.6% on the day, and today we jumped another 1.2%. Also HYT, this is also known, by the way, as junk bonds. Anybody wondering, HYT, high yield corporate securities, are junk bonds. This is how I would describe this as cautiously moving upwards here without a lot of conviction. It's kind of rightfully scaredly moving higher, in my opinion. But the last main chart I want to share, this is wood, actually. I had talked about previously how it had looked like it had a pretty clear double top and broke down and confirmed, and it looked like it wanted to go bearish. In the last 2 days, we popped right back up into this range, and so from that perspective, this whole previous pattern is doesn't have as much or any meaning anymore, really. And this one makes a little more sense. This is more of a leading indicator, like, okay, rates are going to go down. This makes sense to go up a little bit. But what doesn't make sense is the combination of the S&P 500 and the Qs showing a lot of weakness, all while, traditionally higher risk assets such as the Russell 2000 and also HYT, junk bonds, high yield corporate, are moving higher. One way to look at it that in the way that I'm looking at it is with my own insight. I'm thinking that the market is acting like things are okay, so it's like okay to get out of fake safe names like Nvidia and mega caps, which is what's making these, S&P 500 and the Nasdaq fall and rotate into small caps. And this reminds me very strongly of what had happened actually at the end of 2021 when everyone started doing the same thing, piling into ARK at the exact worst possible time. So we'll see how this works out. I don't mind investing myself in things, in stocks. I don't think it's appropriate to not have any stocks ever. Graham, in his books and his suggestion, says never have less than 25% stocks. And when I'm looking out there at what do I want to have, well, there's a lot of beaten down value stocks out there in areas that are very unloved, such as China, Brazil, rare earth metal, strategic metals. REMX is a fund that I have a good amount of, as well as very unloved stocks that don't deserve to be beaten down as much as they are, like Zoom actually and Nissan are my top two stocks right now personally. But as far as small caps go overall versus the S&P 500 mega caps, this is like it's in a way people thinking that they are safe enough to take out of things that they're thinking are safe, like I said, and go into things that they think are a little more risky. And I don't think Mr. Market is thinking very clearly right now with this. But, I guess I can have a little bit of a sigh of relief in a way that, like, people are finally taking some money off of the table on these mega caps that are incredibly overvalued to the point where they're valued like they're practically meme stocks. It's gotten so out of hand, and the worse that was going to get out of hand, the worse the collapse, the harder the rug pull, and the more people could potentially get hurt. And so, a relief rally, a rotation, of sorts. It's interesting, very interesting to see what's going on here. The last notable thing that I wanted to point out today was Fed funds futures rate for the September 18th Fed meeting. We notably went yesterday, previous probability of one rate cut from 83% to 90%. And so, like I've been saying before, at this point there's no reason to believe otherwise at the moment. Oddly and correctly, the market is giving a sigh of relief of looking for lower rates because, yes, cheaper borrowing costs are good for business, good for earnings, therefore good for stock valuations. It all makes sense. It all fits together until you look at the broader context of what rate cuts really mean, which is that things are slowing down, and when things slow down, they tend to continue to slow down while the Fed chases it down. Will it happen that way, the way it's happened every single time before? I think it's very probable. I generally don't like stocks right now. Like I've been saying, I think bonds are great. I think cash is great. And that's just me and my crystal ball. And that's all I have for you today. Hope you enjoyed. Thank you for watching. Robschild.